Hello and good morning, and welcome to our discussion about the pitfalls of 401k audits and why you need to and what you need to do to prepare and ensure the process goes smoothly. 401k plans are an important benefit to attract and retain talent, so it's critical to everyone that the administration is done properly. And employers want to ensure that employees can maximize their plans to save for retirement. My name is Shirley Collier. I'm the president of Scale to Market and host of the Growth Masters Federal podcast and moderator for today's panel discussion. Our esteemed panelists who will help us look at this topic from three different perspectives: the employer, their 401k auditor, and the CPA firm perspectives are Lisa Anderson, founder of Anavo Transformation, Ruben George Delgado Powell from Brontide, and Chris Schneider from Tribridge Partners. Sorry, Chris, for messing that up. I'll let each of you give a brief self-introduction. Lisa, can you go first, please?
Yes, thank you, Shirley. Good morning, everyone, and welcome. I am Lisa Anderson. My company is Anavo Transformation Solutions, where I serve as fractional CFO and compliance advisor to small and mid-sized companies in and around the federal government contracting community. When it comes to 401k audits, or actually any type of audit, as a matter of fact, I sit in between program offices as well as the auditors, helping employers translate plan documents and infuse them into day-to-day operations. I also help to ensure payroll and HR practices align with plan documents and put the internal controls, documentation, and governance in place so that audit processes run smoothly. So I guess in a nutshell, I'd like to say we help clients remain audit ready and compliant year after year.
Thank
Thank
you,
you for
Lisa.
having me.
Thank you, Lisa. And Ruben?
Thank you very much, and good morning, everyone, and welcome. Very excited to be here this morning. I'm Ruben Delgado Powell, and I'm the director in charge of the Employee Benefit Plan audits at Brontide, where we not only audit employee benefit plans, but also provide assurance and tax services to government contractors. When it comes to the 401k plan and other employee benefit plans, for that matter, we're the ones that you call when it comes time that you're required to have an audit of your employee benefit plan.
Awesome. Thank you, Ruben. And Chris?
Yeah, good morning, everyone. My name is Chris Schneider. I'm the director of the retirement division here at Tribridge Partners. We serve as a co-fiduciary advisor for the clients we serve. And so that means we create an investment policy statement for our clients. We help them with the investment due diligence, their fee benchmarking, and then also their employee education services. As it pertains to audits, we are not the ones performing the audit, but we are certainly involved in plan design discussions that are plan design and really operational discussions that are relevant to audits. So really, helping our clients to stay in compliance. And then there are documents that are oftentimes requested related to investments and fees when the audit occurs. So we are also involved in that process.
Thank you, Chris. And Jessica Stark is behind the scenes working the technology. Thank you, Jessica. So, our goal today is to give our audience a clear understanding and a path to a smooth 401k plan audit. There are many aspects, pitfalls, and compliance concerns to be aware of when the time comes for the required audit. So, today we will prepare you for the first year plan audit and how to put the necessary guidelines in place to smooth out your yearly plan audits going forward. We have three categories of questions that we will ask each panelist. We will then open the floor for questions. You can also ask us questions via the question feature in GoToWebinar. Use the chat feature to chat with one another. So the first question for our panelists is, what do most companies misunderstand and get wrong with a 401k audit? Ruben, can you get us started?
Sure thing. So one of the misunderstandings is that there sometimes tends to be a mentality of the auditors will catch it. Well, keep in mind that if you know that there's an error, you want to be proactive and fix it as soon as you can. Because when you find the error right then and there and you fix it right then and there, it's all said and done, it's taken care of. But sometimes if you let the error just go, it can become more costly, not just in fixing the error itself, but also from an audit perspective. The audit is budgeted a certain way. And yeah, sometimes there is a little bit of wiggle room there for error detections when it comes to the audit budget. However, depending on the error that is discovered, if it's egregious or vice versa, those audit fees may become a little more costly as those errors are not necessarily part of the scope of the audit itself. And not just that, some of these errors may require legal intervention, which, us as auditors can't really step over that line, so to speak. So bottom line is, don't wait for the auditors to find the mistake. If you know that there's a mistake, go ahead and fix that mistake. Keep in mind that auditors can't be part of your internal controls, so to speak, as that is essentially an independence matter.
So Ruben, I have a few questions for you. The first is, anytime someone hears the word auditor, they may think of IRS audit, which can be quite intimidating. So how do you differ from an IRS auditor?
So the misconception is that audit or auditor does not necessarily mean IRS or DOL. If you hire a firm like Brontide, do keep in mind that we don't work for the IRS or DOL. We're an independent accounting firm that you've hired to come in and issue an opinion on the financial statements. That's it. It's not like we're picking up the phone calling the IRS saying, oh, hey, there's all these errors that we found. You may want to check up on them. You want to look at us more like a partner, a business partner, so to speak, not an enemy. Also, a little fun fact, the term auditor derives from a Latin term means a hearer or listener.
So that's interesting. So the second question is, how can employers be proactive, and what should they do to prepare?
So monitoring plant operations is a big thing when it comes to this. What an auditor likes to see when you're monitoring the plant operations is, so first things first, there are a lot of third parties involved, but when you outsource to a third party, it's not necessarily a set it and forget it type of thing. The auditor is going to want to ask you questions like, how often do you meet with your service providers? Or has your service provider made you aware of any types of security breaches? Another thing that comes down to monitoring plant operations, and it comes down to two words, is meeting minutes. Okay, you want to be holding these meetings to talk about the plant operations, talk about compliance, talk about any issues that have come up. Who was there? What did you talk about? What decisions were made, and why were those decisions made? Another thing you'll hear is a SOC 1. Well, why is that important? Well, SOC stands for the System and Organization Controls. 90% of the time, your third parties will have this. In summary, it is a large report that contains an audit report on the design and operating effectiveness of your third party's controls. It is voluminous. It's got a lot of words and stuff in it, but at the end of the day, it's like a roadmap of how your third party does things. And it also has that auditor's opinion. The unmodified opinion, which is the clean opinion, is key, of course, but every once in a while you'll see a modification to the opinion or a qualified opinion with a reason as to why it was modified. Again, just because the plant operations are with a third party, you can't just let it sit there and be. With that said, the SOC 1 report is going to have things in there that say, well, hey, as the service organization, we have these controls, but there are also going to be these complementary user entity controls, which means from the service organization perspective, our controls will cover this, but you as well as the user need to have these recommended controls in place. And then, of course, your plan documents and agreements. Part of monitoring is making sure that you have all your ducks in a row when it comes to your plan documents and agreements. I'm not sure why, but ever since I started my career in this, I have been provided documents that have not been fully executed. This is very common, and if I had $1 for every time that happened, I could purchase a brand new car. Document is not effective unless it has been fully executed. And on that note, we also need to make sure that us as auditors that you provide to us the most recent document applicable to the plan you're being audited. And if you have any amendments subsequent to the year being audited, it's always helpful to provide things of that nature. Remember, fully executed documents, it's not valid if it is not signed.
Thank you, Ruben. And Chris, from the 401k advisor perspective, what do you see your clients often misunderstanding, and how do you advise them?
Yeah, thanks, Shirley. I think starting off with the investment piece, because we're very involved in the investment due diligence process. Right now, a lot of questions come up around revenue optimization in the industry. And of course, we have in 401ks, you have mutual funds that are available. They have all different types of share classes. Those share classes will determine the amount of revenue that is shared back to the record keeper to offset plan administrative fees and advisory fees. And there are situations where we find, a plan sponsor using a revenue share class that is not the most efficient. So meaning that the employees are actually paying more for that revenue share class than another one that's actually available on the platform. That can be problematic from an audit perspective as well. That there has been litigation around this in the industry, unfortunately. So understanding if your platform and the share classes you're using are the most efficient is vital to remaining in compliance. There's something called fee levelization now that most platforms offer that we do recommend evaluating for your plan. And that's something that would help, potentially from a efficiency standpoint. From a plan design perspective, I think understanding the definition of compensation is also, vital to remaining in compliance. So we have, clients that may not understand what exclusions exist in the plan, or they may make an assumption where they're, making contributions and not including all compensation or some portion of compensation that should be included. So looking at your adoption agreement, understanding, are you excluding bonuses? Are they included in the plan design? I use bonuses. That's a popular exclusion we often see. If you're a safe harbor plan, understanding also, if you're excluding, certain levels of compensation, that could have an impact on the testing components, because now you're safe harbor for a reason. You want to be, exempt from testing. All of a sudden you're excluding some level of compensation, and now you have additional tests that are required. The last thing I'll mention is just match determination period. So a lot of people believe, hey, if I'm funding my match every pay period, that is the calculation period for the match, which may not be the case. You may have an annual determination period for your match. And what that means is that you're then required at the end of the plan year, once we have the full compensation for that plan year, to be doing a true up of the match. And so that requirement, is something that you need to know as a plan sponsor. What we find is that most, administrators, TPAs, and record keepers will assist and notify a plan sponsor, but there are some record keepers that are requiring the plan sponsor to request the true up calculation. So you as a plan sponsor would need to know, okay, even though I'm funding per pay period, it's still based on annual pay. So we need to go through this true up process. So those are really the three areas I want to mention, Shirley.
So a couple of follow-up questions for you, Chris. Related to investment revenue, does this vary depending on the record-keeping platform a client is using?
Yeah, so what we're finding is that most record-keeping platforms now do have fee levelization available. The question that we have to determine for a client is not all platforms are allowing what's called a revenue credit back to the participant. So if it's not allowing that sort of crediting back to the employee, that will determine what share class we're using, whether it's the zero revenue share class or maybe a more efficient version that is crediting the revenue back to the employee. So it really does depend. Again, I do recommend discussing that with your advisor.
And regarding the true up, how would someone know if this is required and when it needs to be completed?
Great question. Yeah, so it is plan document driven. You can find it in your adoption agreement. So I would recommend, again, either asking your record keeper, the TPA, or the advisor. They should have access to that information and be able to let you know if you have an annual calculation period. And then a lot of people question, well, if I have, why would there be a disparity between a per pay period and annual calculation period? Usually what we're finding is that disparity would occur for people who are maxing out their contribution early. So let's say you front load your contribution, you max out by June. Now you have, several months, 6 months without, receiving a match. So at the end of the year, when they do the true up, they may realize that you're actually owed additional match based on your annual, compensation. So that calculation is done, the true up, Shirley, is done in the first quarter, typically. Like we're going through that, over the last month, late January, early February, when the compliance questionnaire comes out and the testing is being completed. That's typically when the true up the true up calculation will occur.
Great. Thank you for that clarification. Lisa, is there anything you would add?
Yes, thank you, Shirley. And I'm just going to build on what Chris and Ruben have already shared. And from a CFO perspective, what I see as the most common mistakes is that companies believe that compliance is an outsourced function and that other outside, like plan administrators, are the ones that are responsible for the administration of the plan, while record keepers and advisors play a very critical role in this process. The fiduciary responsibility, always have to understand that the fiduciary responsibility always remains with the employer. And so what I see as issues that arise with employers of all sizes is number one, payroll, human resources, and finance are not aligned. There's a disjointed activity that's happening while they're playing some role in the record keeping of the 401k plans themselves. They're not working together collaboratively to make certain that the organization is compliant, the employer is compliant. Plan provisions are not revisited as the company grows. That's a critical component. A lot of companies continue to rely on the old plan and always say one of the greatest books I've ever read is What Got You Here Won't Take You There. And so you have to think about that from a plan perspective as well. As the company grows, certain things need to change as well. And then no one is actively monitoring whether or not the plan is operating exactly as the plan is written. One of the things that I know is a opportunity for success in any type of audit is self-policing. And it is going through the process internally periodically to make certain that your processes, your documentation are all consistent and then also compliant in accordance with the plan documents. So a 401k audit, I love what Ruben says, that the auditor is listening, right? It's a listener. But I also like to say an audit is designed to reveal potential challenges with the plan administration itself. And a strong governance throughout the plan's life cycle prevents surprises.
So Lisa, when you say governance, what does that actually look like in practice for small to mid-sized companies?
Yeah, that's a really good question. When you think about the word governance, it sounds like a big term, and it can be intimidating in some respect, but it doesn't have to be complicated. Governance is really bringing about clarity, consistency, and communication. Those three things are important throughout the life cycle of a plan. And it does not have to mean creating a large committee or adding some level of bureaucracy through the process. It is just really simply following a few steps. So the first step is obtaining a clear understanding of ownership. Who is explicitly responsible for the plan? And it's usually finance or HR with some CFO level oversight to make certain that the plan and the operation components are operating as they should. Everyone knows who owns what, including the payroll processing, contribution timing, and coordination with the advisor and the record keeper. So that's the first step, is to make certain that there is clear ownership. The second step is to make certain that there is alignment between the plan document and daily operations, and that's critical. That's key. The company understands how compensation is defined, as Chris said earlier, how eligibility is defined, and how the match is calculated and applied. And the roles are reflected accurately in payroll and HR systems. The third step is there is regular monitoring, even if it's informal. So as I mentioned, we want to make certain that we are policing throughout the life cycle of our plan. So this might mean an annual or semi-annual check-in to review contributions, match calculations and fees, and to confirm nothing has changed operationally that could create a compliance issue. And then finally, there's communication through documentation. Key decisions, reviews, confirmations, and documented and retained in a simple fiduciary file. And the documentation is what demonstrates prudence during the audit. So good governance requires intention, oversight, and discipline to check that the plan is working the way that it is supposed to.
That's excellent. Thank you so much for that very clear explanation. The second category of questions for our panelists is about the areas of an audit that might have the greatest impact on employees. So, Chris, what are your observations?
Yeah, so first and foremost, I'll mention contributions because I think that's probably an area that comes up very frequently for auditors. And it's really being consistent and timely with your contributions. And it's essentially like as soon as practicable for a client to make the contribution. Timing, the consistency is essential as well, where if let's say you're making a contribution the day after payroll is run for several months, and then you have a month in the year where you make the contribution 5 days after payroll is run. That would not reflect well, especially like in an IRS audit, because you have now demonstrated that you are able to make the contribution the day after payroll is run. So just making sure that you are very consistent in that. For small employers, meaning 100 employees or less, there is a little bit of leniency there where there's a 7-day rule of making the contribution within 7 days of payroll. And you could have some, I guess, level of inconsistency for a small employer. For larger employers that are dealing with an audit, which I believe is probably most of the people on the call, there really is not that level of leniency. So you have to make sure that you are consistent and doing it as soon as possible for yourselves. Again, even for small employers, we're recommending consistency to avoid any sort of scrutiny during an audit. So that's one area. I do think fees, I had mentioned earlier about fee levelization, but fee benchmarking is also essential right now. There's a lot of changes in the industry occurring. We have acquisitions happening with record keepers. There are various levers that we can now that are a little bit more transparent than they were years ago, where we're able to negotiate fees down quite a bit for plan participants. Department of Labor requires a plan fiduciary to benchmark their fees at least every 5 years. We recommend 3 to 5 years to our clients. And so with the change in dynamics of record keeping and fee compression that we're seeing in the industry, I do think that negotiating fees is essential. Fee benchmarking, that's going to have a direct impact on your employees and their performance ultimately.
So, Chris, what are some of the signs that a plan may need to be benchmarked?
Yeah, I think anytime there's an acquisition in the industry for a record keeper, that would be a time to benchmark, obviously. So if you're changing platforms, as well as plan demographic changes in your plan. So if you have, let's say significant growth in the plan, $2 or $3 million, or if you have acquired a business yourself, all of those would be characteristics of, a need for fee benchmarking. And then also if you just are unaware of, whether or not you've done it in recent years, I'd highly recommend, then going through that exercise, because having that documentation is also, very important to staying in compliance as a plan fiduciary.
Thank you, Chris. So Lisa, regarding greatest impact on employees, from a CPA perspective, what do you see?
Yeah, so as a CPA, I'm going to speak from a CFO's perspective. The areas that have the greatest impact on employees, I would say, and I'm going to reiterate what Chris just said, are contribution accuracy, timing, and transparency. Employees are not or may not understand the plan documents. In many cases, they don't, but they absolutely notice a few things. The first thing they notice is when contributions are late. So it's extremely important that employers submit contributions in a timely manner. And one of the things that I recommend is to make certain that contributions are put on the calendar, literally placed on the calendar with reminders that contributions are to be submitted, within a certain period of time. Employees will also notice employer matches when they are incorrect. And they will question that. So it's always a good idea to have a secondary calculation that is reviewing and validating the primary calculations that are being performed before you make those submissions. And I think the last thing is when corrections show up on a plan, an individual's plan, but there's no clear communication about what those corrections are. So that goes back to the communication components of governance. It's just making certain that if there's errors or corrections that need to be made, they are transparent and they're communicated with the employees. So these issues can affect morale, employee morale. They can affect employee trust, and at the end of the day, they affect compliance. So again, what I advise to clients is to put these things on the calendar, make certain that they are important, that they are executed consistently, and treat your 401k process like it's payroll. You wouldn't. It is a high priority for companies of all sizes to ensure that payroll goes out on time and accurately, and the same thing should be. It should be the same process in the same way for 401k as well.
So what systems or controls do you recommend to prevent these issues from happening in the first place?
Yeah, so there, a lot of systems currently have uh, processes in place to make certain that, that there are controls that exist centered around the plan itself. Many companies use platforms like ADP or maybe even Paychex or some other payroll provider. And these systems, again, have the controls in place. And if you're using these systems, you want to be intentional and then also regularly review and check the controls that these systems do actually have in place. So consistency is absolutely recommended. So the first thing is to make certain that your payroll system aligns with the plan documentation. So I'll just use ADP as an example. Inside ADP, there are contribution codes and compensation definitions, eligibility rules, match formulas. All those things exist within the payroll processing system. Anytime that there is a change in the compensation, bonuses, or pay frequencies, or in the plan itself, you want to go back and make certain that the payroll system is updated to account for those changes. I think the second thing is to make certain that you're automating contributions and that there is oversight in that process. What I mentioned before is just making certain that there's a secondary process that validates the contribution calculations and the timing of that. So ADP can automatically, it can automate the deferrals. It can automate the employer contributions. It can integrate with the plan, the systems that where you're submitting the information, your plan system itself. So those things can be set up in the system. But again, you want to make certain you have certain processes in place that review and validate the information that is being submitted, and try to catch any errors that may occur before those errors are transferred into the plan system itself. And then I think the third thing is that reconciliation. Typically, taking a look at it on a quarterly basis. I personally, as a CFO, take a look at these things on a payroll by payroll basis, even before. So once payroll is prepared and before we make the submission, many of the systems will give you reporting where you can actually do the calculations and validation before payroll is submitted. That way you have an opportunity to reconcile and correct issues before they're submitted to the payroll company. And then I think the next thing is making sure that there's a good separation of duties. You want to make certain that, as I mentioned before, human resources and payroll and finance, they all play a role in the 401k processes. And I think it's good to have good separations of duties so that there's not one person is handling all of the critical components, and then there is also oversight. There's leadership. There's an opportunity to catch errors. And then I'm going to say finally is documentation and monitoring, making certain that payroll reports, contribution confirmations, and plan communications are established in a fiduciary file. Anytime you maintain a file that collects history of transactions or decisions or things that have happened with the plan, it makes an audit process easier to be able to go back to that file and pull support when questions may arise. So the systems are usually capable, they are, but from a controls perspective, you want to make certain that you're mitigating any risk and that you put these safeguards in place.
Thank you, Lisa. And Ruben, from an auditor's perspective, what would you add?
So from an auditor's perspective, what we see a lot of is errors when it comes to the definition of compensation and missed deferrals. So why this happens, as previously mentioned, when there's a misalignment between the plan document and operations, this is what this comes to. When it comes to the missed deferrals, in case you're not familiar, this occurs whenever an employee makes an election to have amounts withheld from their paycheck, but it doesn't end up happening, or it happens untimely. So some steps that can be taken to avoid this is, first of all, pulling that plan document to understand the definition of compensation. Yes, I know the plan document is overwhelming. It has a lot of words. It's got a lot of sections. It's sometimes 100-some pages, but it must be fully understood in order for smooth sailing to occur. This is step one, always, every time, especially for the audit side. We cannot audit what we don't understand, which is why that plan document is so important. And don't forget the amendments as well. You can always consult with your service providers, especially the one who helped provide you with the plan document, to help you understand some of the provisions if they're not clear. The summary plan description can be a good starting point because it is supposed to break it down in an easier to read format. But always keep in mind that the plan document is what governs at the end of the day, always. And as Lisa mentioned, integrations for automatic feeds are great, but you have to check up on those every once in a while. Your record keeper should be able to provide you with the ability to run deferral election reports or periodic feedback files for you to be able to do a cross-check to make sure that if somebody elected to have 10% withheld from their paycheck before the payroll was ran or vice versa, that they are actually having 10% withheld from their paycheck. So yeah, making sure that you check up on this every once in a while is great. Delinquent participant contributions. Now, we did touch on this a little bit, and get comfortable because, yeah, this is an area where a lot of back and forth tends to occur. I hear I was out that day, or the payroll person was out on PTO. Keep in mind that those aren't necessarily valid excuses. I've also heard others say I have till the 15th to remit. I know we touched on the 7-day safe harbor a little bit. If we pull the actual regulations, okay, if we start from the beginning there, the key to this is that the regulations state the assets of the plan include amounts that a participant or beneficiary pays to an employer or amounts that a participant has withheld from his wages by an employer for contribution or repayment of a participant loan to a plan as of the earliest date on which such contributions or repayments can be reasonably segregated from the employer's general assets. If you look at the 15th provision that we just touched on, it says, in no event shall the date determined occur later than the 15th business day of the month following the month in which the contribution amounts are received by the employer. And as mentioned previously, if you can demonstrate that you have withheld and remitted the employee's contributions within 1 day, that's essentially your due date at the end of the day. You've been able to demonstrate that within that day, you can reasonably segregate employee contributions from the general assets of the sponsor. Keep in mind that this is somebody else's money that you're dealing with. Your employees have trusted you, the employer, to take money out of their paycheck and handle it in a manner that they've requested. So when it comes time to audit those contributions, we're generally going to ask for a schedule for the entire year that compares the payroll dates to the dates that the funds were remitted to the plan. And we're going to look for a very consistent pattern of remittances. If there's a deviation, well, depending on the circumstance, we may have to include a separate supplemental schedule in the financial statements that gets attached to the 5500 and vice versa. Another thing that we're going to recommend is that you consult with legal counsel. And there may be just disagreements, and it might be okay, but we're probably going to ask you to look into certain remittances because you may think that 3 days longer that it took you to remit a participant contribution isn't delinquent, but DOL or IRS may think differently if they happen to select you for an audit. So those are just some of the areas we see from the auditor's perspective.
Thank you, Ruben, for that clarification. It seems like it can be quite scary to kind of go through this process. So the
I had
last
a question come in from the audience real quick that I wanted to interject with before you guys went to the next topic.
Yes.
Is it advisable to have your record keeper and TPA audited annually to review investments and fees? And are there any companies you can recommend to do this?
So I guess I can answer that one, I believe.
Yeah. Mm-hmm.
Yeah, I think, again, it just depends on the plan demographics. Like under $1 million plan is going to be a challenge because there's not as many record keeping options available. If you're in the environment where your plan is growing, certainly we do recommend evaluating your investments every year, at least annually. Usually for auditable plans, it's going to be semi-annually or triannually, even quarterly for some of our clients. So we absolutely do recommend that. And then the fee negotiation, I do believe, should happen every year. And then a broader, more formal fee benchmarking, we would recommend every 3 to 5 years. At TriBridge, we're doing that for our clients as a co-fiduciary advisor. So it's really going to be a co-fiduciary advisor that's likely spearheading that project for you as far as the investment due diligence and the fee benchmarking. And then lastly, you asked about the companies that we would recommend. There's a lot of great record keepers. There's probably 15 that we are currently working with. And then you get into whether your plan is going to be unbundled or bundled, as well as 403B, 401k. I know we had titled this as a 401k meeting, but I know it's also relevant to 403B plans. So depending on a number of variables, there could be, 8 to 9 vendors, maybe even a few more that we are evaluating. But we'd be happy, to have that discussion with you.
So reach out to Chris and we'll make sure that you have his email address. Good. Okay, so one last question for our panelists. How do I know if my company is ready for an audit? So Ruben, I want to go back to you, stay with you as an auditor. How do you define a well-prepared client?
So keeping in mind things that an auditor is going to ask for, like those adoption agreements, plan documents, related amendments, agreements with your service providers, census files, nicely reconciled out to the Form W-3s or the 941s, meeting minutes, having all of that ready for your auditor, and then also having any types of, what is the word, corrections for issues that you noted during the year, having that ready as well. Because if the auditor's aware of certain errors in the plan, they're going to want to see the corrections. So making sure that you have all that like ready to go in one folder, ready to upload to your auditor is just something to keep in mind. And then you want to also make sure that those who are involved in operating the plan are also available for the audit. So the person in charge of the day-to-day operations, your payroll person. You'll want to introduce your auditor to your representative at your third parties, like your record keepers, and also, of course, those charged with governance. Mind you, they may like the trustees or those charged with governance may or may not be fulfilling a lot of requests, but your auditor may reach out to them directly and ask them a couple of questions about the plan. And then before you commence your audit, just do your checkup on your plan. Look at the remittances during the year. Make sure you're using the correct definition of compensation. Make sure your contributions for your payroll tie up to what's being reported in the plan. If you need to make corrections, reach out to your third parties and make those corrections as quickly as possible. So those are just some of the tips of making sure that you're ready for an audit.
Thank you, Ruben. So Lisa, how do you help your clients prepare?
Yeah, thank you, Shirley. So my objective is to focus on alignment and consistency. And at the end of the day, I want to make certain that companies are audit ready at any given time. And so what that means is just reiterating some of the things that I've already said, which is to review the plan documents against actual payroll and HR practices, and doing that periodically. Confirming definitions of the compensation eligibility and match calculations are properly communicated and executed. Testing contribution timing before the audit year ends, and just being prepared for what Ruben mentioned earlier is just understanding the trends of the timing and when those contributions were submitted. Assigning clear ownership between human resources, payroll, and finance, and then just making certain that oversight process exists, and creating an audit file, making certain that the audit file is developed and maintained throughout the year versus waiting until the last minute of trying to gather information together. So when we, follow these steps, when these steps are actually in place, the audit becomes more of a confirmation of good management rather than a fire drill of trying to, put it all together last minute and identifying errors in the process and not really having good documentation to support the action. So it is a proactive process.
Lisa, at what point should a company start preparing for a 401k audit, especially if it's their first one?
Today. I mean, in short, you want to be audit ready at any given time. So it is good to start preparing for an audit before an audit is necessary.
Yep.
So based upon the things that you've heard in today's discussion, I would start evaluating some of those things. Start with the plan document. Make certain that the key players understand all of the components, break it down into maybe a checklist so that, everybody understands the key components that we need to be paying attention to on a regular basis, and start doing those review processes for contributions and submissions on I would say quarterly, but I really want you to get to a point where you're doing it monthly, not just quarterly. But in short, I would say you want to start now, today, before
Yep.
it becomes necessary.
Yep. Good advice. Chris, what would you add?
Yeah, so proactively, we are scheduling annual or fiduciary review meetings with all of our clients. So at those fiduciary review meetings, we want to have on the agenda items related to plan operation, plan governance, plan design. We want to have legislative updates related to Secure Act on there. We are reviewing the investments in the plan demographics. And then after those meetings, we are keeping a fiduciary file of everything that happened. So meeting minutes and all the documentation during the audit process. Usually we are, being requested to send over the meeting minutes for all those meetings. So I think having that fiduciary file in advance is essential. And then just having a really kind of a holistic plan review at a minimum annually is, certainly something we would recommend.
Great. Thank you. Thank you, Chris. So in summary, 401k benefits can help companies attract and retain top talent, but there are issues to consider and responsibilities to be undertaken by the plan administrator, the plan auditor, and your CFO. So it is important to prepare for audits to ensure they go smoothly and are stress-free. We always want to be stress-free. And to review your plan to ensure maximum morale, trust, and benefit to all employees. Competent advisors, auditors, and outsourced CFOs are key members of your company's brain trust. Now, before we open up the floor to questions, I just want to let you know that our very generous panelists are going to be sending to you afterwards several resources to help you prepare. So please look for an email from us. And I think that there will also be a link to this recording that will go out to everyone who registered. Okay, so we have a couple of questions here. So Ruben, the first question for you, looks like there's 3 questions for you. The SOC 1 report is overwhelming and hard to understand. What are some tips for making the SOC 1 easier to read and understand?
Sure. So just take it section by section. Sometimes those SOC reports can be well over 100 pages. But some of the significant areas that you want to focus on are that auditor's opinion, the tests and the results performed by the service auditor, and any responses to any exceptions that were noted by the service auditor. In addition to that, complementary user entity controls are another area that I'd recommend you focus on. Again, those are the controls that your service provider recommends that you have in place in order for things to operate smoothly. Now, not all auditors do this, but some may provide you with a template that will summarize that 200-page document into a nice and easy to follow 2-page document. So that's my advice when it comes to the SOC 1.
Okay. Awesome. And what advice do you have for making sure that contributions are remitted to the plan in a timely manner according to the Department of Labor regulations? And we touched upon this a little bit, but you may want to elaborate.
Sure. So establishing a remittance policy and sticking to it. Don't just create one and toss it in the corner and never see it again. Having that policy not only helps to demonstrate your commitment to best practices, but also can help you in standardizing the process in an area that is relatively, it can be subjective when it comes to this type of matter.
And the third question for you, Ruben, is if I've received a notice from the Department of Labor or the IRS, what do I do?
Take a deep breath. Okay. Don't just panic and respond immediately. Reach out to your service providers, reach out to legal counsel, let your auditor know, and work with them. Figure out what it is that's being asked, and get to the bottom of it. Again, don't let the panic take over. I know sometimes that's easier said than done, but again, taking deep breaths, reading the notice, and utilizing your resources is the best approach to making sure that the notice gets addressed correctly and timely. And yeah, don't just throw it in the corner either. You receive a notice, you definitely want to address it as soon as you can.
So Lisa, what are the top 3 things a company can do this quarter to reduce their risk and stress going into their next audit?
Yeah, I would say the first thing is to validate the alignment between the plan documents and your payroll. Pull your plan document and confirm that eligibility, compensation definitions, deferral limits, and the employer match formulas are being applied correctly in payroll. This is extremely important if there are bonuses or pay increases, or if you have a different type of pay class code that is established in your system, or if there's been any type of changes in your plan document in general. You want to make certain that your payroll system is aligned with the plan document. The second thing is, I would say, to review contribution timing and correct any issues early. So let's start with our best practices now moving forward. Look at how quickly employee deferrals and the contributions are made and being deposited into payroll, and how many days is it taking for you to do that, and can we close that window and be consistent? We want to make certain that we're catching and correcting timing issues before an audit occurs, and not only reducing findings, it demonstrates proactive fiduciary oversight. So we want to make certain that we're doing that. And I think the third thing is to, again, create and maintain that fiduciary file or audit file, and just start gathering the appropriate documentation. Once those things are in place, now we have the ability to easily pull information, to review the key parties that are involved in the 401k process overall, has a one source place to go and review information, just to make certain that, again, we're following the plan as it should, and we have proof of that. So this helps to be prepared, to reduce risks, to lower stress, definitely, and to put leadership back in control of the audit process instead of, addressing this under pressure.
Yep, very good advice. So Chris, there are a couple of questions here for you. How do I know if we are using the most efficient mutual fund share class?
Yeah, it can be challenging for sure on the platforms to understand that there is an all available list that typically will share the amount of revenue that each share class is generating. And that's something that the provider can provide to you. The issue with those lists is that they have thousands of funds on them. And so we do generally, I would just recommend circling in your advisor. Hopefully you're working with a co-fiduciary that can, really do that for you, since you've hired them to do so.
And the second question for you, Chris, is, do most plans include bonuses in their definition of compensation?
Yeah, interesting. The bonus is probably the most common exclusion we are seeing. We have a lot of conversations around that, and there are plan sponsors that just prefer not to include that in their definition. I think if I were to take a guess, I would think that, it might be 10 to 15% of our block is probably excluding bonus compensation. And again, as I mentioned earlier, it's more rare to have that sort of exclusion when you're a safe harbor plan, even though it does exist. But then there are additional, testing considerations for those plan sponsors. So it's not, extremely common, but it is an exclusion that we do come across, frequently.
Yep. Thank you for that, Chris. So Jessica, are there any further questions from our audience? I'm assuming that's a no. Jessica?
No additional questions came in. Sorry, I was.
Great. Thank you. So thank you to the audience for attending today, and to our panelists for sharing their extensive knowledge. We'll be sending out links to the recording for listening on demand, or if you want to share it with other members of your team. And also there will be a checklist to websites, peer review opinions, and other resources for everyone who registered today. So thank you again. Have a good day, and we'll see you next time.
Thank you.
Take care. Thank you.
Thanks, everyone.